Okay, so in my opinion, the biggest risk with income shares is the fact that you have upside potential that is capped. So on the website, it says that they sell up to 5% about the money weekly call options on Nvidia in this case. Obviously for Coinbase, it's the same thing. So let's just assume that 5% is what they do every week. So that means we're capped at 5% gain. So for example, today is the 22nd of April and Coinbase has a 9.25% gain. So we've missed out on 4% essentially. Well, roughly 4%, it keeps changing. So obviously we haven't included the premiums there, which are going to be slightly higher because they always increase when there's a lot of volatility in the underlying stock, because IV just essentially represents how much people think the stock's going to move. So if we've just been capped at 5% plus the premiums for this week, then let's say next week it drops 10%. We have like full exposure to that 10%, obviously minus the premiums we receive for that. But if that keeps happening over time, which it probably most likely is, then the fund is going to decay because of that. So essentially you have to keep replenishing the fund with your dividends to kind of keep up with that. If that happens, obviously I'm not saying it's gonna, but that is a scenario where it could happen, because if you look at any covered call selling ETP or ETF or anything, you see that they drastically underperform the underlying index or stock. And that is because of what I'm saying here. Because in the market, say the S&P for example, there is just a few days a year where the majority of the gains are made. And if you're selling calls during those times, then you're just limiting yourself at the end of the day. So if we have a look at last year, for example, if you sold calls all the way through that last year, then you're doing worse than what you would have done if you just held the actual index itself. And obviously in my mind that MSTR is coming shortly to income shares, and I've been having a look at Yield Max. Missed the ticker symbol is. And that underperforms the actual underlying stock itself. And it always will do. And people understand this because they just want the income and they'll accept that trade-off. But I thought maybe just for the purpose of learning more about these ETFs and ETPs, even though I've learned a lot already about them, I thought I might as well share what I think the biggest risk is, because it's hard to actually conceptualize what these ETPs do. And it kind of seems like there's not much risk in it, but essentially you have to reinvest the dividends because of the fact that you get full downside exposure, but you have limited upside exposure. So on them days where a stock's going to do 20%, you've just limited yourself now, but now you have the full downside of that. And obviously companies work that way. They work around Q10 reports and quarterly performance and sales and all that. So when you get the earnings calls, IV on options is obviously more because people expect more movement around those periods of time, and the stock's going to increase if the earnings are good by quite a lot. So you're going to miss out on them. Obviously, selling calls all year round, every year, is probably the best solution. But I think that for a good stock, you'll still make a gain, but holding the underlying is going to be the most profitable thing. So, but then again, on the other side of the coin, let's say you bought some Tesla income shares ETP like I did, and then it dropped drastically. Then you can just use the dividends to reinvest it back in to kind of reduce your cost average. So it kind of helps you not lose out in the long term. It gives you a higher chance of making a profit essentially, because the volatility is reduced drastically as well. But you can put the dividends back in and you can reduce the cost of the shares that you bought. So you can kind of dig yourself out of the hole. Might take you a while. And if you keep putting the dividends back into the ETP, you're still going to be capped on the upside. So it's going to probably take a good while to get out of that hole. So yeah, it's just something I've been thinking about. I thought I'd share because I have had a few questions regarding the ETPs, and obviously diving in a bit deeper is something I'm interested in and I want to discuss. So quick message here, you see that the distributions are not guaranteed. So mostly they're going to be, the dividends are going to be there, but in the event of like a market crash, for example, you know, companies cut dividends and stuff like that. Obviously income shares will do the same, but I think in the event of a market crash, it's bad all around, so it doesn't even really matter, I guess. So yeah, that's just what I wanted to add, and yeah, catch you later.